Every time the stock market crashes, people act surprised. They say, no one saw it coming, but Charlie Munger did. Over and over again. In fact, the late Charlie Munger spent decades pointing to the same patterns that show up before every crash. And right now, those patterns are back. In this video, I am going to look at 4 major financial disasters spanning over 4 centuries and break down how each one followed the same dangerous playbook. We're talking about the Panic of 1792, the Panic of 1907, the Mexican peso crisis in 1994, and the global collapse of 2008. Each of these seemed stable until, suddenly, they weren't. But what makes them important isn't just what happened, it's what always happened before. Because before every crash, there are 4 signals, 4 patterns, warnings hiding in plain sight. And what's even more interesting is that all of them map directly onto what we're seeing right now, especially under Trump's economic influence and the current state of the markets. The goal is not to scare you, but to show you what to watch for, so that when the next crash hits, and it will, you're not panicking. You're prepared. Before we begin, as always, this content is for educational purposes only and is not financial advice. Investing involves risk, including loss of principal. Past performance does not guarantee future results. Always do your own research or consult a licensed financial advisor before making investment decisions. With that in mind, let's start where the story really begins. America's very first crash in the 1790s. The first major market crash in American history didn't start with a war or a plague. It started with a man who thought he was smarter than everyone else and a market that believed him. In the early 1790s, the United States was still new. There were no federal banks, no SEC, no safety nets. Just a bunch of wealthy men trading government bonds in coffee houses on Wall Street. And one of them was William Dewar. Dewar had been part of George Washington's Treasury Department, but he left to chase something more exciting. Money. He saw an opportunity in the country's early government debt and started borrowing huge sums to speculate on it. He even created shadow companies to hide what he was doing, a primitive version of today's shell corporations. At first, it worked. Bond prices rose, more people piled in. And Dewar? He kept borrowing more to buy more. The market loved it. Investors assumed it would keep going up forever. He became a financial celebrity of the day. People followed his moves blindly. But it didn't last. In March of 1792, Dewar couldn't repay his debts. Word got out. Investors panicked. The market collapsed. Prices fell across the board. There were riots in the streets. Dewar ended up in debtor's prison where angry mobs gathered outside his cell. Not just because he lost money, but because he took everyone else down with him. And here's the interesting fact. None of this was hidden. The signs were everywhere. One man was controlling huge portions of the market using borrowed money. People saw it. They ignored it. Because back then, like today, the crowd believed the story more than the math. They believed prices would keep rising, even when logic said otherwise. Charlie Munger called this kind of behavior irrational exuberance before the fall. He didn't believe markets were efficient. He believed they were emotional. And that emotion, especially the emotion of greed, clouds judgment. This crash revealed the first warning sign Munger always looked for: investor overconfidence. It's when people stop asking what something is worth and start assuming it will just keep going up. When analysis turns into hope. When the smartest guy in the room is just the loudest. And in this case, that confidence wasn't based on fundamentals. It was built on borrowed money, on leverage, on the illusion of growth. That's why Munger always said, the big money is not in the buying and the selling, but in the waiting. He believed in staying calm when others were getting reckless, and recognizing that the greatest risks often come from people who look like they know what they're doing. Munger often warned about the madness of crowds, and that's exactly what we saw here. Ordinary investors followed the herd, thinking they were on the path to easy wealth. They didn't realize the foundation beneath them was cracking until it was too late. The Panic of 1792 wasn't only a financial disaster, it was a social one. It shook public trust in the financial system before it even had time to mature. And it set the stage for future regulatory reforms, but those wouldn't come for over a century. And unfortunately, this kind of behavior didn't stop in the 1790s. In fact, it was just the beginning. At the turn of the 20th century, Wall Street was booming again. The Industrial Revolution had minted a new class of wealthy investors, and stock speculation was becoming a national pastime. But behind the scenes, the system was dangerously fragile. There was no central bank, no Federal Reserve, no emergency safety net for banks or brokerages. Everything ran on trust and a whole lot of leverage. And that's what made the panic of 1907 so destructive. It started with a failed scheme. A financier named F. Augustus Heinze, through his brother Otto, tried to corner the market on United Copper Company stock, a mining company they controlled. The plan was to buy up most of the available shares, create an artificial scarcity, and force short sellers to scramble to buy them back at inflated prices. At first it worked. The stock surged from around $39 to over $50, briefly touching $60. But the Heinzes had miscalculated. There were more shares in circulation than they realized. Short sellers easily found stock from outside sources. Within 2 days, the price collapsed to nearly $10. The damage didn't stop there. United Copper wasn't a major public company, but it was tied to a fragile network of banks and trust companies connected to the Heinze family. When the scheme failed, confidence evaporated. Depositors rushed to pull money from banks linked to Heinze, triggering a wave of bank runs. Rumors spread. Was Heinze's bank in trouble? Were his connections with other firms toxic? People panicked. And when people panic in a system built on confidence, the whole thing unravels fast. Bank runs started in New York. Depositors lined up to yank their money out. Trust companies, similar to modern investment banks, began to fail. The entire financial system was teetering on the edge. And here's where it gets interesting. The U.S. government had no mechanism to stop it, no backstop, no intervention. So who saved the day? J.P. Morgan. One man, personally, stepped in to stabilize the system. He locked bankers in a room, forced them to disclose their books, and organized emergency funding to stop the bleeding. It worked, but just barely. And the panic revealed something crucial. The market was flying without a parachute. All it took was one failed scheme to shake the entire foundation. This is the second pattern Charlie Munger warned about: regulatory blind spots. It's when a financial system gets too complex, too fast, and no one's watching the edges. When there are no rules, or worse, when the rules exist, but no one is enforcing them. The Panic of 1907 led directly to the creation of the Federal Reserve in 1913. It was a wake-up call. Markets need circuit breakers, guardrails, structure. Because unchecked capitalism doesn't self-correct, it self-destructs. This is Munger's second pattern: regulatory blind spots, systems that are too confident in their own strength, leaders who believe the market can police itself, and a lack of guardrails when things start going off the rails. It's a pattern that didn't end with 1907. In fact, we're seeing shades of it today. More on that later. By the mid-1990s, Mexico was riding high. Foreign investment was pouring in. The economy was growing, and the country had just signed the North American Free Trade Agreement. It looked like a rising star in the global economy. But just beneath the surface, things were starting to crack. Mexico's central bank had pegged the peso to the US dollar and defended that peg by issuing dollar-denominated debt, tesobonos, while burning through foreign exchange reserves to maintain stability. A violent uprising in Chiapas and the assassination of presidential candidate Luis Donaldo Colosio in early 1994 rattled investors and triggered capital flight. As reserves dwindled dramatically, from about $26.8 billion in March to dangerously low levels by year's end, speculators smelled weakness. In December 1994, the government was forced to devalue the peso between 13% to 15%, shattering confidence and prompting panic. Investors rushed for the exits. The peso collapsed further, from roughly 3.4 pesos per dollar to nearly 7 by early 1995. Inflation exploded, hitting 52% that year. Interest rates spiked, businesses went bankrupt, and Mexico spiraled into a full-blown crisis. What happened wasn't just a financial accident. It was the result of poor decisions, conflicting incentives, and delayed action. And this brings us to Munger's third warning sign: policy missteps and political risk. Charlie Munger was crystal clear about this. He said, "Show me the incentive, and I'll show you the outcome." In Mexico's case, the incentive was political survival. Leaders wanted to look strong and stable, even if it meant hiding the cracks. But eventually, reality catches up. And when it does, there's no hiding. The US had to step in with a $50 billion bailout to stabilize the region. It worked, but the damage was done. The crisis wiped out savings, destroyed trust, and stalled growth for years. Generations of economic progress were undermined in months. And here's why this story matters today. Because we're seeing similar patterns play out right now. From trade wars and tariff threats to public attacks on the Federal Reserve, the Trump era has been defined by policy unpredictability. That unpredictability creates fear, and fear moves markets. Add in the recent headlines, debt ceilings being pushed to the edge, rising deficits, political gridlock, and you have an environment where economic stability is being used as a political chess piece. That's exactly the kind of setup Munger warned against. And the incentives? They're all political. If leaders are rewarded for short-term wins, they'll chase them, even if the long-term cost is massive. They'll paper over cracks, inflate confidence, and hope the crash happens on someone else's watch. That's what happened in Mexico. And it's dangerously close to happening again. Markets don't just respond to numbers. They respond to confidence, to leadership, to credibility. And when policy becomes a game of optics instead of substance, the market eventually calls the bluff. This is the third Munger pattern. When political ambition overrides sound economics. When policy is used to chase votes instead of to protect the future. When warning signs are dismissed because they're inconvenient. And if you think we're past that now, just read the headlines. Just look at the incentives. Now, let's look at the fourth pattern with one of the most recent major crashes. By the early 2000s, the US economy looked unstoppable. Housing prices were rising, mortgage approvals were easier than ever. Wall Street was booming, and home ownership was sold as the key to the American dream. But beneath that optimism lay a fragile foundation. Banks had figured out how to turn risky home loans into investment gold. They packaged those loans into securities, called mortgage-backed securities and CDOS, and sold them to investors around the world. The idea was simple. As long as people kept paying their mortgages, these investments would be safe. But no one really understood how risky they had become. Charlie Munger warned about this kind of innovation. He didn't trust financial products that were too complicated to explain in plain English. And these products? They were built on layers of assumptions, debt, and wishful thinking. The problem was everyone involved had incentives to keep the machine going. Mortgage brokers made money writing loans. Banks made money packaging them. Rating agencies made money labeling them AAA. And investors thought they were getting safe, high returns. It was a system where everyone won, until the defaults began. When homeowners started missing payments, the whole thing began to unravel. Because these weren't just isolated loans. They were tied together, stacked, sliced, and sold around the world. No one knew exactly where the risks were. All they knew was that everything was connected, and it was collapsing fast. In September of 2008, Lehman Brothers filed for bankruptcy. That single event triggered a global panic. Markets crashed, banks froze, businesses shut down, millions lost their jobs and homes. It was the worst financial crisis since the Great Depression. And here's what makes it so relevant to Munger's thinking. It wasn't caused by a war or a natural disaster. It was caused by a complete failure to understand the risks we were creating for ourselves. This is the fourth pattern Munger warned about. Innovation without understanding, made worse by leverage. Munger often said, "It's not supposed to be easy. Anyone who finds it easy is stupid." But in the years leading up to 2008, making money felt easy. Too easy. Real estate investors were flipping houses like trading cards. Wall Street was inventing new derivatives every week. And regular people were taking on debt they couldn't afford because the system told them it was safe. Munger didn't hate innovation. He hated complexity without comprehension. He believed that if you couldn't explain how something worked to a reasonably intelligent person, you probably shouldn't be putting your money in it. But people weren't asking those questions. The hype was too loud. The profits were too tempting. And so, like in every crash before it, confidence replaced caution. Growth replaced scrutiny. And logic got buried under the assumption that this time was different. It wasn't. The 2008 crash showed us what happens when financial systems become too complicated, too interconnected, and too dependent on borrowed money. It was a warning shot for the modern economy and a perfect example of what Munger meant by idiotic behavior. The problem is, we didn't fully learn the lesson. In today's markets, we're seeing a new wave of risky behavior. Tech stocks trading at fantasy valuations, meme stocks driven by social media hype, crypto projects built on thin air. Leverage is back. Speculation is back. And once again, people are trusting systems they don't fully understand. Munger saw the same warning signs. He stayed out of crypto, called it rat poison squared, and refused to chase trends he couldn't logically explain. The question isn't whether innovation is bad. The question is whether we understand what we're doing with it, whether we're building resilience or just inflating another bubble. So here's the fourth Munger pattern. When innovation outpaces understanding and the debt used to fuel it makes everything more fragile, that's when the system cracks. So now we've looked at the four patterns Munger warned about: investor overconfidence, regulatory blind spots, policy missteps, and innovation without understanding. And in each crash, we've seen how those forces played out in different ways. But let's shift from the past to right now. Because here's the question that matters most. Are we seeing these same signs again? Today? Let's start with investor overconfidence. Stock prices for some companies are wildly inflated, trading at hundreds of times their earnings. Meme stocks are still driven by hype, not fundamentals. Crypto coins with no clear utility are being treated like serious investments. People are pouring money into assets they don't understand, hoping for overnight gains. It's not investing, it's speculation. Now, look at regulation. Financial innovation is outpacing oversight. AI-driven trading funds, crypto-based lending platforms, tokenized assets, and leveraged ETFs are growing at a pace regulators are clearly struggling to match. Some agencies have even admitted they're playing catch-up. Then there's policy. The economy is being used as a political chessboard. We've seen repeated debt ceiling brinkmanship, massive fiscal deficits, and interest rate uncertainty. Politicians float threats of default as a negotiation tool. Markets rely on stability and predictability, but these standoffs signal neither. And finally, innovation without understanding. Complex financial products are back. Platforms offer 20% returns on deposits with little explanation. New forms of decentralized finance are praised before they're tested. Technologies are being monetized before they're fully understood. And we're seeing a rush to adopt, not a pause to ask the right questions. Add in the global uncertainty and political headlines, like new tariffs, budget showdowns, and challenges to central bank independence, and it's not hard to see the signs lining up again. So, what's the play here? In today's economy, the smartest thing you can do right now isn't to guess when the next crash will hit, but to position yourself so that when it does, you're not scrambling. That means first understanding what you own. If you can't explain it in simple terms, it's probably not worth the risk. Avoid hype-driven assets and high-leverage bets. They might look exciting now, but they're often the first to collapse when the cycle turns. Stick to fundamentals. Invest in businesses with real earnings, strong balance sheets, and long-term value. Stay diversified. Don't chase trends, especially when they're being sold with buzzwords instead of logic. Keep cash or short-term reserves on hand, not because you're scared, but because flexibility is power. When prices drop, those with dry powder win. And most importantly, stay calm. Volatility is normal. The headlines may scream panic, but real investors play the long game. Crashes come and go, but patience, discipline, and clear thinking always win over time. The stock market is getting chaotic right now. And if you want to see what smart investors like Michael Burry, Warren Buffett, Howard Marks, and Bill Ackman are doing about it, click the video on screen.